welcome. Thank you so much for joining us today. We are here to talk about buying a home with a specific workshop designed by Bank of Hope for military and veteran families throughout the country. GoVA is so honored to be hosting this event in conjunction with Bank of Hope sponsorship. I'm Lizanne Lightfoot. I'm the VP of Marketing at GoVA. I'm a Marine Corps spouse and a proud member of this community. I'm very honored to have two Bank of Hope experts with us today to talk through this topic. So let's jump right into it. Helani, can you go ahead and introduce yourself, talk about your role at the bank and the specific details that you're bringing to this conversation today?
Absolutely. Hi, Lizanne, and hi, everybody. Thank you so much for the warm introduction. Yes, my name is Helani Nunez. I've been working in the financial services industry for over 20 plus years. And my areas of focus and expertise are consumer business banking. And this is a great passion of mine in really helping our families in achieving or what it's like in the home buying process. Thank you.
Wonderful. And we are looking forward to it. We're also excited to have with us Thomas of Bank of Hope. So please go ahead and introduce yourself.
Thanks, Lizanne. Hello, everyone. It's so nice to be with you. Today. My name is Thomas. I am the CRA officer at Bank of Hope. I've been in banking for over 20 years. I've been doing CRA, which is the Community Reinvestment Act for banks. I've been doing that for about a little over 7. I oversee the CRA aspect for the bank for lending, for investments, and for the financial literacy programs that we do. And I love this topic. I may not be like the most subject matter expertise on the topic, but the reason I love it is that I honestly never thought in my wildest dreams that I was going to buy a home. And it just so happened that in 2009, the opportunity presented itself because at the time, there was a first-time home buyer program that was funded by the federal government. Ever since then, I've been really passionate about it. So I can't wait to talk about what we're going to talk about. Helani is going to cover the first half, and then I'll take over the second half. So thank you all.
Wonderful. We look forward to hearing from you as well. And I wanted to share that GoVA Foundation, of which all of our viewers today are members, is focused on providing financial education and improving financial literacy in our military and veteran communities. So we partner with banks throughout the country, like Bank of Hope, to sponsor free access for our members to have a library of financial resources at their fingertips. We call it The Edge. You'll be hearing a little bit in this presentation today about some of the tools and calculators and resources that might be useful to an Edge user throughout their home buying journey. So with that, I'm going to bring up your presentation and invite Helani to jump in and share the focus of today's topic, what we're going to be covering, and I know there is a important disclaimer from the bank to read as well. So are we seeing the screen here?
Yes. Awesome. All right, so a quick disclaimer. This presentation represents the views of the speaker and not necessarily those of the agencies they represent. This presentation cannot be reproduced or distributed by a third party or on a third party website without prior authorization. Reference to any specific organization does not constitute an endorsement, a recommendation, or a favoring by the FDIC or the United States government.
Thank you for getting that one out of the way.
All right, so today's objective, learn about the home buying process. We're going to learn how to know if you are ready to buy a home and estimating how much you can afford. Home financing options, key costs, and how to compare loan estimates. How to get pre-qualified, what does that mean? Or pre-approved for a mortgage. The role of the various professionals involved in the home buying process, who's doing what. The process of making an offer, negotiating with the seller, and closing the purchase. Where to get help if you're having trouble making mortgage payments. So we're going to cover a lot of important topics.
Wonderful. And I'm looking forward to those. I do want to encourage our viewers as you're watching this presentation today, if you have questions for either of our presenters, please feel free to add them in the chat, and then we will ask your questions and review them when it's an appropriate time. So with that in mind, please go ahead, anyone who's watching, share in the chat which part of the country you're tuning in from and any particular home buying experience that you might be bringing to this conversation today.
Absolutely. We do encourage collaboration. Please reach out, just drop it in the chat. Absolutely. Looking forward to hearing your questions and where you're calling from. Absolutely. All right. So buying a home. Getting ready to own your own home. So how to get started. Section 1, key takeaway. Buying a home is a process. Start by making sure you're ready to buy and figure out what you can afford. And this is important. Right, next slide. Putting together your team and finding a home. Real estate agents, who else might be playing a role in helping you buy a home? We're going to be looking at lenders, appraisers, housing inspector, title insurance agent, housing counselor. So there's an array of team experts that are pretty much involved in this process, because it is a process and it's important to understand who does what. So for example, for an appraiser, provides an estimate of the home's value. You can learn about appraisers and what they do by searching or understanding residential appraisers, or by visiting this website, www.usa.gov. The lender qualifies you for a loan and lends you the money to help you in the home buying process. The housing inspector identifies key problems with the home before you buy it. For information on home inspections, go to this website once more, www.usa.gov, and search for home inspectors. Include your state's name in the search for state-specific information. And this can actually help you in your home buying process. So for example, if the home is not up to code and it does require the buyer, to bring this house up to code, like for example, maybe it needs a new roof, or maybe the pool is not up to code, you can negotiate, right, what that would cost in the sale of the home. So I think this is a great benefit to have, and also to make sure you have the right home inspector, because you want to go through every nook and every cranny of the home buying process to ensure everything is covered. Attorney, sometimes a few states require that an attorney writes a real estate contract, search for the title, and conduct closing instead of real estate agents and title insurance companies. There's also a title insurance agent, researches the title of the property to make sure the seller has a right to sell it. That is important. As a buyer, this is a very expensive purchase, so you definitely want to make sure that all of the legality, all of the paperwork has been researched, but also has been recorded accordingly. Insurance agent also determines whether the property can be covered by insurance and recommends how much insurance is needed and how much it will cost. That is also something to consider in the home buying process. Housing counselor provides you with education and counseling on the home buying process. The U.S. Department of Housing and Urban Development, HUD, approved housing counselor provides advice on the home buying process. So they also provide assistance, and they can be visited at www.hud.gov/find-a-counselor, or you can call 1-800-569-4287, or you can also reach out to a local bank or credit union, or you can also reach out to us as well for help and guidance.
Thank you. I think it's always amazing how it takes quite a village, and it can be a really intimidating process to begin.
Yes, but it's important to start planning and preparing, especially if this is something that you would like to do. Absolutely. Steps to buy a home, getting ready. Decide if you're ready to buy a home, figure out how much you can afford, check your credit history. So this is important. This is where many people want to rush through, but it's actually the most critical step. You need to honestly evaluate whether you're ready for the responsibilities of home ownership. Figure out what you can truly afford and check your credit history. Every individual does have access to checking their credit history. You can do so by going to www.annualcreditreport.com and review your credit reports. The website is the only place where you can get a free credit report from 3 nationwide credit reporting agencies. And these are your Equifax, Experian, and TransUnion. And as of now, you can access your credit reports free weekly at the site. Checking your own credit reports does not affect your credit, which is important. Again, the website is www.annualcreditreport.com. And step 2 is really figuring out the financing. Learn about mortgages or other financing options. You can shop around, get pre-qualified or pre-approved. And this involves learning about mortgages and other financing options with your direct lender and possibly your real estate agents as well.
For sure. And I know we'll talk a little bit more about that difference between being pre-qualified and pre-approved. So if you have questions about that, just hold tight. I do want to point out too for our viewers that you can do a lot of these steps on the Edge as well. So you can get a credit check and a free credit report through the Edge. And you can also use a lot of free tools there to be comparing different mortgage rates, understanding your options, and really getting the vocabulary so that when you go to someone like Bank of Hope to approach them about a mortgage, you'll have the right questions, the right terms, and feel more empowered in your decision making.
All right, more steps to buying a home, right? Shop for your home, right? Put together your team, your real estate agent, your home inspector, your broker, your loan officer. Put together your team. Find a home that fits your needs that you can afford, right? And that is very important. So as you're looking for a home, you definitely want to see, if it's going to meet your needs. Are you looking for a 2-bedroom? Are you looking for a 1-bedroom, 1-bath? Are you looking for, a home that has a backyard, a home that has a driveway, a home that has a garage? I mean, these are needs that are specific to you. So it is important that when you are looking for a home, that you don't rush the process. You definitely want to take your time and find your home that fits you. Find your home. You can make an offer, and believe it or not, you can negotiate. You can look for similar homes that have been purchased in that area, and you can negotiate. And you can also use this to your advantage when you do have a home inspector, right? If you do need a new roof, if some of the outlets within your home need to be updated and up to code. So these are all things to consider, and you can negotiate with the seller. Consider a home inspection, and also to see how soon is this home buying process. How long does it take? Does the seller have a specific time frame that they would like to close the sale of their home? And number 5, maintaining your home. So remember that homeownership has a lot of responsibilities and continue long after you receive the keys, right? So there is maintenance, whether it's, the water heater, whether it's the fridge, the washer, the dryer, the roof, does it leak, the AC. So these are all things to consider when you're plumbing. These are all things to consider, and I've had my share of experience in my home ownership experience. So you really have to consider the entirety of owning a home.
For sure. And it's certainly a lot for our military families to consider. So we're going to also be exploring in this presentation some military specific scenarios like the VA loan. So we will also be getting to that soon.
And how much can you afford? Only you can decide that. There are 2 ways to estimate this. Here's a crucial principle. Only you can determine what you can truly afford, not your real estate agent, not your mortgage lender, and not, meaning family members. You are the one who must make that monthly, those monthly payments and handle the ongoing cost of home ownership. And that is really, really important. Can you afford it? Every month you definitely have to, pay that mortgage, and we want to make sure that you're able to do so. Lenders will tell you the maximum amount they're willing to lend you, but the maximum is often very different from what you should comfortably spend on housing. There are 2 primary methods to determine your comfort zone. First is your spending and savings plan. This involves analyzing your actual monthly budget to see how much room you have for housing costs while maintaining your other financial goals. And second is your debt to income ratio. What does this mean? This is calculated by lenders using your, the approval process, but you should understand it for your own financial planning. And debt is anything from, are you leasing a vehicle? Do you have any student loans? Are you paying for any other credit card debts? These are obligations that you have, so you must consider all of your debts, and you can write them down, you can add them, but if you're having, challenges in really finding out what you're responsible for, you can find this information on your annual credit report. And of course, your banking associates, your lenders can also help you with this information as well. And then you divide that by your gross, right? Your actual income, like how much money you bring in. But your gross is different from your net income. So you definitely want to distinguish, your gross may look a lot more on paper, but I would consider to really focus on your net, right? Your paycheck, what you bring, home, and that is what you should really consider in your in making this home buying process.
For sure. And I think a lot of military families just assume that I can get approved for whatever the BAH rate is, and I'll just use my BAH to calculate my mortgage payments. And I think the options that you laid out here are much more not only specific to each family's situation, but they're also going to be a lot more effective for people who are getting out of the military, veteran families. When you don't have a BAH calculator to base your numbers on, these are the real numbers that you should be using.
Absolutely, and thank you so much, Lizanne. And this is something to consider, right? Your monthly mortgage payment, PITI, right? The amount borrowed, right? Your principal borrowed, interest on your mortgage payment, real estate taxes. Here in California, I do have my mortgage compounded and amortized with its taxes, so that is something that needs to be paid twice a year. And homeowners insurance, that is also factored into your monthly payment, and that is also needed and required here in the state of California. But please check with your state or local county or community to see what is required to have on your monthly mortgage payment. Oh, and one thing to consider too, if you do live in a community, there's also something called homeowners association. So if you do live in a community, that can also be factored into your mortgage payment. I don't live in a homeowners association community, so that is not something I need to worry or consider. But if you do decide to live in a community that is gated or has that is something to consider as well. So going into your debt and income ratio, right? We briefly talked about that, but that is the total monthly debt payments divided by your total monthly gross income. Shows how much of your monthly gross income before taxes or other deduction goes to covering your monthly debt payments. We can go over an example on the next slide. So for example, let's just say your total monthly debt payments are $2,045, and again, this can be a combination of many debts from your, if you're leasing a vehicle, if you're purchasing a vehicle, student loans, personal loans, credit card debt, all of the above. And then you divide that by your monthly gross income, $3,750. So that's going to give you a decimal of 0.5453, but when you convert that to a decimal, so your debt to income ratio is 54%.
Do you have a target of what's a good number? Do we want that to be larger? Do we want it to be smaller? Like, what's the aim in that scenario?
So you definitely want this to be well, we require here at Bank of Hope, and most lenders do require a debt to income ratio of at least 50%, but you definitely want to make sure that this is a lot lower, because you're going to put yourself in a position where you definitely don't want to. You definitely don't just want to focus on your monthly mortgage payment, because other things do come up, right? Especially if you have a family, there might be tuition, your family may want to do maybe some traveling, some entertainment expenses. There's other things that may need, some maintenance, around the house, whether it's plumbing, water heater, goes out. So you definitely want to make sure that this ratio is much, much lower. The lower, the better. Absolutely. Good question. So remember that, buying a home is a process. Start by making sure you're ready to buy and figure out what you can afford. It is a journey. You can start by asking yourself, am I truly ready for home ownership? What can I realistically afford? And you have to start by laying a strong foundation by assessing your readiness and setting a sustainable budget is absolutely critical to your long-term success. The mortgages, there are many programs out there, whether it's 10, 15, or 30 years, but it is a commitment. Never let anyone rush you or push you beyond your comfort zone. A home that stretches your finances too far isn't a dream, it becomes a burden. It's worth taking the time to get this right from the very beginning by being thoughtful and realistic in your planning today. You're setting your future self for a success, and trust me, you'll be grateful you did.
Thank you, Hailani. And I know we're going to transition into section 2 in just a moment, but I want to thank you for your expertise in that section and encourage those who are watching, if you do have questions about that initial homeowner process and how you begin all the topics that Hailani just covered, then please ask those questions in the chat and he'll be happy to address them. And as far as getting approved for larger than you should be paying out in a mortgage, I can say that absolutely does happen for military families. I think we bought our first house when my husband was like an E5. We're both young in our 20s and had moved to an area. We got approved for twice as much as we ended up actually spending on our mortgage. And so the number they're telling you can spend is not necessarily the number that you should for your budget. And that's why we're going through this, so that everyone has a solid understanding and can make a decision that they personally feel comfortable with. So with that, I want to introduce Thomas and talk about some of those details of once you have started that process, found that home and chosen it, how do we go about financing such a large purchase?
Lizanne, I'm glad you mentioned that, because I mentioned I had the opportunity to buy the first house still in the house back in 2009. We got approved for like double the amount of what the house ended up, what we bought for. So yeah, I think it's still happening now. They're going to give you more than you need. So tread carefully, I would say. But yeah, Hailani, we were talking in section 1 about like the foundational principles, which are important because then it builds us up to the ability to get more into like the details of it. So we're going to talk about financing in the second and last section now. For kind of main takeaways, we're going to identify different types of mortgages available to you and the different options that are out there. And then we're going to define important loan terms and concepts. We're going to describe how mortgages actually work, like what's the mechanics of it. We're going to talk about an amortization schedule and what monthly payments look like very specifically. And then lastly, we're going to discuss the importance of shopping around and the key, like defining terms that you need to know that allow you to shop around essentially. So let's go right into it. So learning about mortgages, some kind of like fundamental definitions to understand. So a mortgage is simply a loan specifically designed to buy your house, your condo, your townhouse, whatever it is that you're going to be buying. And that actual purchase is the collateral. So your house is the collateral, the townhome, or whatever it is. And if you don't make the payments as agreed, you have the unfortunate circumstance that because it is the collateral that you could be foreclosed on. The principal is the actual amount of money that you're borrowing from the lender. So that's the base loan amount that you're taking out. But see, when you're taking out money, there's costs associated to it. So it's layered in different components. So I think we're most knowledgeable about interest payments, right? Interest is the cost of using the lender's money expressed as a percentage. But there's also things called points. Some lenders may offer you the option of buying points, And essentially, if you do that, you're exchanging upfront payments for the possibility of lowering your interest rate. So points could be a smart choice if you plan on living in your home for a long time, because that interest amount that you're going to save over that span of whether it's a 15-year mortgage you're taking out or a 30-year, you're going to save money over time because you're paying less in interest. So it's just dependent upon the situation and how long you plan on living in the home for the most part. But there's also fees associated to the mortgage. This is what the lender charges you for processing the application. What does that entail? There's the possibility that you're going to be charged application fees, processing fees, and other underwriting fees associated to financing the mortgage. And then there's other charges too, such as an appraisal fee, which ultimately determines what the value of the property is. So remember we talked about that interest expressed as a percentage. So I don't know if you've heard of it, but APR stands for annual percentage rate. I think this essentially is the overall cost of the loan on an annual basis, encompassing not only the interest rate, but also additional fees and charges associated with the loan that you're taking out. And that is the key component that you're essentially going to use when you're shopping for a mortgage is, hey, is this lender's APR lower than this lender's APR? It's kind of like that key piece. Yeah, we're going to cross-reference to see if the fees are cheaper at lender A and lender B too, but really the main driver is going to be that APR. So let's go to the next, and we're going to talk about what a down payment looks like. So the down payment is the portion of the home's purchase price. So let me give you kind of a very simple example. So let's say that the lender requires a minimum down payment of 5%, for example, in order for them to approve the mortgage. So if you're purchasing a home for $600,000, that means that you would need to come out of pocket at least $30,000 up front. That's because 5% of $600,000 equals $30,000. So the remaining mortgage that you're responsible for paying on a monthly basis is going to be $570,000. And they're going to use that and amortize that over your payment cycle, which we'll get to in a second. But the key relationship to understand, a higher down payment means less money that you need to borrow. I mean, of course, easier said than done. Have you saved enough for a 3% down payment for an FHA loan? VA loans require 0 down payment. Do you have enough to put no money down and then finance the full purchase price? More than likely, if you go for a traditional mortgage, you're going to need to at least put down 20%. And that will give you the ability not to have to pay for what's called private mortgage insurance, which we'll get into in a sec. But it's really kind of the key driver on what you can expect to pay over a monthly basis. Okay, so I mentioned private mortgage insurance, PMI. Let's talk about that on the next slide. And remember, I told you I bought my house, me and my wife bought our house in 2009. We did 3% down because we didn't have the 20% down for a traditional mortgage. So because we did that 3%, we had to pay what's called private mortgage insurance. So if your down payment is less than the traditional 20% of the home's purchase price, you have to carry what is called PMI. PMI essentially exists to protect the lender, not you. It's in case you don't make the payments on time and as agreed. It's a little easy to get it confused. This is not your homeowner's insurance payment that you're making, because the homeowner's insurance is to protect you against maintenance and things that happen to your home. But the PMI is really kind of like a stopgap between you and the bank that's lending you the money in case you don't make the payments as necessary. But one nice thing about PMI is that you can actually get out of it. And the way that you do it is that you have to build up enough equity in your home that's between 78 and 80% that can get you out of the PMI. So essentially what happened for my wife and I with this mortgage was that we eventually built up that necessary equity, and we ended up kind of doing two things simultaneously. One, we got rid of the PMI because the equity was up to that percentage, but we also refinanced into a lower interest rate at the time. Which now that's really hard because interest rates are so high, but There is a way out if you don't do that 20% down up front. So let's go and transition into taxes and insurance, because Halani was talking about the PITI. Let's talk about it more in its components. So there's two main ways that the taxes and insurance are handled. So option one is through an escrow account. I wish I had this still. I had it before we refinanced. It's so much easier, I think. Essentially what happens is the lender collects a portion of your annual property taxes and your homeowner's insurance out of that monthly payment that you pay to them. Option two is what we're dealing with now, is that we pay these bills on ourselves. So when we refinanced our loan, we went to a credit union. The credit union did not do this escrow account, or sometimes it's referred to as an impound account, where they take your monthly mortgage payment and include the taxes and insurance. Now, we have to do this separately. And if you're doing it separately, it's important to kind of budget out to know what the cost is going to be. Essentially, it shouldn't change if you have a fixed rate mortgage. But as we're going to get into in a second, even though you have a fixed rate mortgage, the other items can go up in price. Your property taxes can increase and your homeowner's insurance can increase. So effectively on option two, you're making 3 separate payments. That's what I'm currently doing right now. Let's go to the next slide. So,
Thomas, I can absolutely relate to that.
Right? Yeah.
We have both a property tax and a school tax in our area. The school tax ends up being higher than our property tax. And if that's a once a year bill that you're paying for thousands of dollars and it's not built into your monthly mortgage payments, you absolutely need to be saving for that or budgeting that as your monthly budget throughout the year, so that you don't just have to come up with $5,000 in a month. So.
Right. Yeah. So like my wife and I have a special like savings account specifically where we sweep money over from our checking account, so that we have that, because we have to pay property taxes twice a year. We have to make sure that we have it saved because they're not taking it out monthly.
Mm-hmm.
And we kind of scratched the surface, right? I said, look, your fixed rate mortgage is going to be, well, a fixed rate. So it's going to be a fixed payment. But the other variables are going to be whether your homeowner's insurance increases or if your property taxes increase. So it's kind of important to know, like, hey, I've got a fixed rate mortgage. My interest rate's not going to change. I pay the same each month, but you still have those variable costs that can kind of go up. More often than not, if you got the fixed rate mortgage, a common mortgage term would be 30 years. But not to say that that's the only option for you, but just remember, hey, my rate's not changing. My payment should be the same, will be the same. But the other two key factors that we just discussed could be, relative within that component. Now, aside from a fixed rate mortgage, let's go to the next slide. There's another thing that's called an adjustable rate mortgage. It's often referred to as an ARM. That's the acronym for it, adjustable rate mortgage. And with an ARM, your interest rate typically starts lower than a fixed rate mortgage, which means that your initial monthly payment should be lower. But unlike that fixed rate mortgage where that payment's not going to change because, say, you got a 5% interest rate, it would remain the same over that 30-year period. The ARM works differently because it's tied to a financial index and treasury rate. So what essentially happens is that it adjusts on a schedule. And usually that schedule is like 1 year, 3 year, 5, 7 year. And essentially what happens is whenever you hit that adjustment period of 1 year or year 3, year 5, year 7, essentially what happens is that ARM readjusts. And you have the potentiality of paying a larger mortgage payment because that interest rate is going to change. It still could be a useful tool. I'm not saying that an ARM is like scary by any stretch. It's going to be dependent upon your situation. But say you don't plan on living in your first home forever. Maybe it's like a 3-year start, or like, I know I'm going to be there for 5 years. An ARM could be a good tool for you to use because you may not have to stay in the home for as long as those schedule readjustments are. So it's definitely something that you could take advantage of depending on how long you plan to live in the home. Let's go to the next slide.
I think for military families who are moving frequently, that can be a consideration. It's pretty common to either sell a home after living a few years on a certain duty station or to continue owning it and renting it out, at which point, if your rates have adjusted, you'd be building that into your rental fee.
And I kind of threw the term around conventional mortgage, but really this is kind of applicable to any kind of mortgage. And it's like, well, I mean, mortgages usually fall within a couple of categories. Conventional mortgages aren't tied to like any government program specifically, even though it's more than likely Fannie Mae, Freddie Mac. But like, what are the like components of things that get you into something like a conventional mortgage? Well, the first thing, and Halani talked about it in the first section, and it's really dependent upon what your credit score is. The second thing is verifiable income. Lenders want to see a reliable income stream, and you're going to have to provide supporting documentation to show that. You're going to have to show your pay stubs, your tax returns, any other financial records that the lender might want. But that's probably the second biggest key component. The third that Halani talked about too is that debt to income ratio. I mean, most banks now, I think we're in like the 50% category where you want 50% and below. But I mean, really traditionally, this number was a lot lower years ago. It used to be something between 30 and 40% that most financial experts wanted you to be around. But now I think housing affordability is just so crazy that number kind of has crept up to now. I think the main standard, like Kalani was talking about, is now we're at the 50 and below. But if you can get it lower, it would be for the better because now you have more house that you're able to afford. Let's talk about the specific types of loans. We're going to talk about government guaranteed loans in the next slide. So conventional loans are kind of the most common, but remember I mentioned when my wife and I bought our house in 2009, we relied on the FHA loan program. There's also USDA loans, VA loans, and then other programs supported by HUD. FHA loans offered through the Federal Housing Administration, you only have to put 3.5% down of the purchase price. Another benefit is that closing costs can typically be rolled into that FHA loan. So you're not burdened with the upfront cost of it having be built into your closing costs. However, remember, I did state that if you're putting down 3.5% and not the traditional 20%, that you're going to be, the PMI will be applicable to you because you haven't built up that equity. But it's at least a good, it gets your foot in the door, I would say, for the most part. But yeah, we have a few different programs, but I really want to go specifically into the VA loans. So let's look at our next slide to qualify for a VA loan. To qualify, borrowers have to obtain a certificate of eligibility demonstrating sufficient military service to meet the lender's requirements for this type of loan. It has to be your primary residence and generally within 60 days of closing. There's that military service requirement. So most active duty service members, veterans, National Guard, and Reserve members, and eligible surviving spouses may qualify for a VA loan. The active duty service member general eligibility is after serving 90 continuous days of active duty. If you're a veteran, service requirement can vary depending on the period of service. Typically, veterans qualify with 90 days of active service during wartime or 181 continuous days during peacetime. Veterans who served between September 8th, 1980 and August 1, 1990 are generally required to have completed 24 continuous months of active duty service. National Guard and Reserve members generally eligible after 6 creditable years of service and may also qualify after 90 days of active service under certain mobilization orders. There's also discharge requirements for this. Veterans must have received a discharge characterized as honorable or under conditions other than dishonorable. This kind of just scratches the surface, at least to kind of get you understanding what like kind of the foundational entry pathway into the VA loan, but you can certainly visit benefits.va.gov, and there's a home loan section that will give you more criteria specific. Let's go to the next slide. VA helps veterans, service members, and eligible surviving spouses become homeowners. Again, www.benefits.va.gov. There's a home loan section with a resource page that you can see here, as well as guidance on the VA loan specifically. The other thing I want to mention for the VA loan eligibility, if we could go to the next slide, you have the opportunity to work with a HUD certified counseling, a HUD certified counselor, especially when preparing to purchase a VA loan, because there's so many qualifications that it's important to understand. So if you work with a counselor, they can help you understand that eligibility that we kind of just briefly talked about. But it's really important too, because beyond our workshop for today, that's where you're going to kind of get that one-on-one financial mentorship from your HUD counselor, who's going to provide you guidance on not only the eligibility requirements, but really guidance on budgeting, saving, understanding home ownership, mortgage terms. They can go beyond what we've kind of talked about here in more detail. So it could be helpful working with the HUD certified counselor. There's also credit and financial counseling too. The counselors can review your credit reports. They can help you understand your credit scores. If you have that debt to income ratio that's a little high, they can help you come up with a plan to reduce your debts. And overall, just develop a strong financial plan that can get you on the path that you need to actually get into the home loan that you're looking to get into. But also, there's ways that allow you to avoid predatory lending, right? It hurts to say that because we're dealing with finances here, people will take advantage of you, right? So it's important to understand those key ideas as well. And then there's also foreclosure prevention and mortgage assistance through HUD certified counselors. They can personalize guidance based on your financial situation once you provide the supporting documentation they need to come up with a specified plan. And then they can help you with either low cost or no cost services depending on the path forward that you're going to have. Speaking of other assistance, if we can go to the next slide, in addition to these government-backed loan programs that we talked about, there's also things that you can take advantage of, like down payment assistance programs that can act as grants or forgivable loans that could help you cover your down payment and your closing costs as well. A lot of these are available for first-time home buyers. A lot of them are really based upon locality where you're buying. There's homeowner first-time home buyer assistance that is facilitated through the federal government. There could be programs that are facilitated through your state government. And there's also locality down payment assistance program that could be dictated upon what county you live in or what city you live in. I know around us, I live in Southern California, the major metro near me, they have a down payment assistance program that's specifically funded through the city. So it could be worthwhile to research what other assistance programs could be out there, and to know that these things can be layered together to help with the down payment and closing costs. For the sake of time, I want to kind of breeze past these last couple of things because I think it's important to talk about any questions that might have come up. But really briefly, I mentioned amortization a little earlier. And essentially what this is it's going to be a table on what you can expect the monthly mortgage payment to be. It's sometimes referred to as an amortization schedule, but the most important thing to understand is that it's a breakdown of what your payment's going to look like over the course of the loan. And one thing I'm going to stress, is that it's super surprising if you've ever seen one of these before to know that all lenders, because they want to get paid up front, are going to put the bulk of the interest payments that you owe them in the front. It's front loaded. So essentially what happens is that you're going to end up making your payment. Most of that payment for the first like 20 years of a 30-year conventional mortgage is all going to go to interest. You are not going to chisel away at that principal amount that you owe on your mortgage because the bank wants to get paid first. So the way the amortization works is that you're not really going to do the big bulk of chipping away at that principal until the back end of the mortgage, until like year 20 of the mortgage. To see this, though, you're going to get that amortization schedule from the lender, review it so that you can see the payment schedule and how it works. But despite them front loading that interest, you can make additional payments if you want, as long as you tell the lender, hey, I'm going to make an additional principal payment each month. You can see on the chart here that if you pay an extra $25, you cut that 30-year down to 26.5 years. If you pay an extra $50 to principal, you now cut 6 years off your mortgage. But I think the shocking thing is always like how much they front load that interest into your payment, and it's really crazy. Next slide, the difference between pre-qualification or pre-approval is going to be dependent upon what your circumstances are. The pre-qual is very much more approachable, requires less information. They're going to want employment information, income information, down payment information on how much you're going to put down, any outstanding debts, social security number. The pre-approval, way more strenuous, way more information. And the reason is that you're essentially getting pre-approved to qualify for the opportunity to do a full application. So essentially you're providing everything the lender needs so that you're pre-approved for whatever house you're going to buy, essentially. So it just depends. The pre-qual kind of gives you an idea if you're dipping your toe into the water with the idea that, hey, I'm ready to buy my first home. The pre-approval is more of like you kind of understand your numbers already and you're committed to whatever mortgage you're gonna get. And I would say that pre-approval sets you up for the opportunity of shopping around for a mortgage, right? We talked about that really important number that you're going to use is going to be the APR to shop around. But if we can go to the next slide in shopping around, I would say once you have that pre-approval, now you can start understanding the loan estimates, like how much you're going to end up paying depending on what kind of mortgage you're going to pay, right? So very important. I wouldn't say that a lot of different lenders are going to be able to provide you different terms because really the interest rates are kind of tied together where lender A, B, and C more than likely are going to offer you the same rate. But one of the things that you can shop for is what fees the lenders are paying and how you can save there. But it's important that once you have that pre-approval, you're able then to kind of know more about the mortgage you're going to shop for. But I think we'll stop there. Our next slide is our key takeaway, but I would really like to pass it back to Lizanne to see if we have any questions so that we're mindful of the time we have.
Absolutely.
Thank you, everyone.
Thank you so much, Thomas. That was very informative. I definitely learned some new things, and I want to thank everyone that is watching today. If you have questions that you want to ask for Thomas or for Helani, then please do add them in the chat. I have some questions of my own, so I will be monitoring the chat and waiting for any of yours to come through. But in the meantime, I do want to turn back to Helani for a minute because I learned a new acronym while you were speaking today. The military community is famous for our acronyms, and we sometimes think that we have all of them, but it sounds like the housing and lending market has quite a few as well. So I heard you mention PITI. I think that was a summary of the qualities in the mortgage, but if you could remind us what that stands for and how to use it correctly in a conversation with a lender, that would be great.
Thank you so much. Absolutely. So PITI, P stands for how much you're paying towards principal. I stands for interest. T stands for taxes, and I stands for insurance. So if you want to know what your monthly mortgage payment or obligation in home ownership, you definitely have to consider all those factors. In Thomas's situation, he doesn't have PITI. He only has PI, principal and interest, and separately he needs to make a taxes and insurance payment. So, some lenders, do offer, that flexibility. For myself and for my family, we decided to, look at, what does this payment look like? What are we responsible for, besides other factors? But, principal, interest, taxes, and insurance. Great question, by the way.
Thank you. I think that's really important to remember. We've talked a lot today about comparing mortgages and the questions to ask when you're going to different lenders. And so we want to make sure that we're making that same comparison, not apples to oranges, and making sure that we're including all the same qualities in each of those calculations. So another follow-up question for you, Hailani. I think this was one of the more complicated slides that you had focusing on that debt to income ratio. I just want to make sure that our viewers do understand it. And so the purpose is to make sure that you have a stable household budget that can afford a mortgage. And you said the lower the outcome, the better. But obviously because of credit card debt and just the average American lifestyle and the cost of homes at this point, we might be much higher than what used to be in the 20s and 30% and closer to a 50%. But could you just review a little bit on how we get those numbers and what that tells the individual when they're getting ready for that mortgage process?
Absolutely. It's a great follow-up question, by the way. So debt to income ratio, right? So we need to first figure out how much debt you have. I'll give you another example. So in this situation, let's just say you're renting an apartment and the only debt you have is your car payment. Let's just say your car payment is $500. Now, I know if you're going to be living in an apartment, there's other expenses such as water, power, gas. That does not go into the debt. These debts are reportable on your credit score. So if you would like to know what you're responsible for, you can definitely pull this free credit report through the annualcreditreport.com, which will be provided later to our viewers. But you look at, in this situation, let's just say you only have a $500 car payment. So you get that number, $500, and then you look at your gross. So how much money do you bring in gross? And let's just say that you get paid, to make numbers easy, let's just say you're getting paid $20 an hour. So you get $20 times 8, that's maybe, so you make about $160 per day. But let's just say you multiply that times 30, is $4,800, just to keep numbers easy. So at $20 in a month, you would make an average about $4,800 gross. This is, before taxes and anything else that gets deducted from your paycheck. So you're going to take $500 because that's your car payment and that's the only debt you have. So you get $500 divided by 4,800, and that's going to give you a debt to income ratio of 10%. That means you don't have a lot of debt, which is fantastic. Most lenders require 50% or less. The lower the number, the better. So that means that when you do look for a home, that means that you still have about 90% capability of really affording and making that monthly mortgage payment. So I hope that makes sense. If you need any clarification or a different example, please share it in the chat. We would love the opportunity to, make it clear and provide you with more examples.
Yeah, that actually really is helpful. And I think that kind of illustrates too the importance that credit card debt or any other type of, student loans, personal loans, how that would immediately start impacting the credit score that you would have, but also this debt to income ratio, because in your example, it was just a car payment. And for every type of other payment, your monthly bills that you're adding on to that, you can see how very quickly it eats away at that percentage. So I think that helps to illustrate that if people can take those small steps to pay down credit cards, to get student loans progressed, any of those small things that we can do will help us be more prepared for that homeowner process. So I think that was really helpful, Helani. Thank you.
I can also add really quick, I'm so sorry that if I can also add this as well. It is important that in this home buying process, the stronger the credit score, the more likely the bank, credit union, or institution will give you a better rate. So if you are embarking on this journey of really, taking this seriously and purchasing your next home, it's important to really look at your credit score, because if you have a good team, support team that's really trying to help you in this home buying process, you might be surprised. Maybe you may have a credit score that is not giving you a favorable interest rate, but if you work with a dedicated team, from some advice or counseling, if they instruct you to say, hey, well, if you pay your credit card down, that's actually going to boost up your credit score by 10 or 20 points. So why don't we start focusing on paying off somebody's credit card debts so that in 2 months from now, you can get a better interest rate on your mortgage?
Absolutely. Thank you for highlighting that, because really that is a big part of what we do at GoVA and providing the edge to our viewers here. It's all about those small steps, the little financial things that you can do. You can't change your bank account overnight. We can't make everyone millionaires instantly, but what you can do is, pay down one small bill, start saving, $20 extra that you weren't saving before. And over time, those small choices really do add up. And so we've had viewers who have improved their credit scores and then become qualified to buy a home. And it really can be a life-changing experience just from making small steps. And so the Edge walks you through that journey and really helps support you along the way. And that's why we do what we do here. But I do want to turn back to Thomas and get a couple extra questions out for you. And again, anyone who's watching, if you do have some questions, feel free to drop them in now. But meanwhile, Thomas, I know you reviewed several different elements of loans and some of the additional fees and charges that come with them. And just remind us, because we all hear so much about the VA loan, what are those specific benefits of the VA loan?
Yeah.
And which ones of those additional fees do not apply in a VA loan situation?
I love the question, because I totally left out when we were talking about that PMI, that private mortgage insurance. Not applicable for a VA loan. So it's a super helpful tool. And like I told you, like when I bought my home in 2009, we didn't put down that 20%, which, you need to have at least 78 to 80% of equity in the home to not have that PMI. So you have to worry about it with the VA loan. So in addition to not having to do the PMI, right, you don't have to have a down payment. So 0 down, right? It's not like having to do that FHA loan that we talked about that requires at least 3.5, or even like the conventional mortgage that we talked about, a 15 or a 30 year, you have to put 20% down, right? The other thing is that with the VA loan, the Department of Veteran Affairs guarantees part of it. So when a lender, essentially what happens is a lender is taking on less risk. So because of that relationship, that duality right there, you could get a small rate reduction because the lender's assuming less risk, and even a fraction of a rate reduction could translate into thousands of dollars over the life of the mortgage when we talked about the amortization schedule. The other thing I would say to piggyback off what Helani was talking about with the debt to income ratio is that with the VA loans, you're going to have a little bit more flexibility on the DTI number. And that is because, again, there's kind of less risk to the lender ultimately, right? I would say there's probably less in association because the VA limits certain fees that a lender can charge borrowers. So it's going to lower your out-of-pocket costs essentially because certain fees are restrictive and they're not passed on like a conventional loan would be. I'm trying to think of other maybe advantages. I mean, maybe I know that there's more flexible credit requirements. So the credit standards are a little bit different than if you were applying for a regular loan. And that goes hand in hand with the debt to income flexibility that is there. And then you have to do, the other thing is too, a consideration of the borrower's credit history. I would say that the underwriting standards are slightly different for a VA loan in consideration of what our military families are encountering on that day-to-day basis, right? And how life can change like that, right? Depending on what orders you receive and such. But yeah, those are some of the other kind of things for the VA loan. But the most important thing I wanted to remind you is the no PMI, which is really good because you're not putting 20% down. I mean, you can if you want, just depends on your situation.
Yeah, no, for sure. Especially with home values today, I think that's a very unlikely prospect for a lot of, especially first-time buyers. So,
Yeah.
Not having to do the money down and not having the PMI together really just would save a user hundreds of dollars per month in their payments. So, VA loan is not always going to be the optimal or the best solution for your family, but it's definitely a benefit worth exploring for our military community. So we always want you to compare and to check it out. I think as we wrap up our time here, is there any final advice that you would have, especially for military or veteran families who might be facing this home buying process? Where should they refer for more questions, and what should they do if they're kind of ready to begin?
I just have one more comment before we leave. First of all, I'm so happy that you're here with us, and I hope that this information is useful at all. Now, again, we have the disclaimer that Helani read that this is our opinions. This is not the opinion of the bank that we work for by any stretch. So the words that come out of my mouth is my experience. I'm 44. I don't know if it's as I get older, but one thing I can at least reflect on, because I've been in my house now since 2009, is that when I was younger, and I think this is applicable for most people, I think we're more risk averse when we're younger. Lizanne, you mentioned that when you and your husband bought your first house, at least you had the wherewithal not to buy more than you could afford, right? But I would say as I get older, I become way more risk averse. I'm becoming more financially conservative. I'm not willing to swing for the fences. So I have a daughter who's in her 30s, and she is making sure that she gets that 20% down payment put together, that she's ready for the traditional way that we described in buying the house. But this is my point. Sometimes you just got to go for it. Look, housing unaffordability, we're at a crisis level. I don't think it's going to get any cheaper. I don't think a 2008 financial crisis is going to happen again. I don't know if we can sit on the sidelines and pray and hope that prices go down. I don't think we can sit on the sidelines and think that interest rates are going to go down. So I would say, and I don't want you to buy more than you can afford, but also sometimes when you take risks and you swing for the fences, it could benefit you in the future. But know yourself, know your situation. Don't buy that more than you can afford. But sometimes we got to go for it. So that's where I'm at right now as far as my home buying thoughts are concerned.
Understandable. Yeah, I think there's so many families that have been, especially these past few years, kind of waiting and saving and hoping and observing and, trying to do the math and figure out what makes the most sense. So sometimes we do need someone to tell us, like, just go ahead and go for it. Hey, Lonnie, any closing thoughts or advice that you'd like to share?
Again, thank you so much for your time, and, thank you all, for your service. Really appreciate what you do for our country and what you do for all of us. So first and foremost, absolutely, thank you so much. And we understand this journey can be daunting. It can be, nervous at times, but just know that, to begin or to get started, do some research. I know Lizanne has some great resources on her site, and she can definitely guide you in that process, but really know what you qualify for. Take your time, do your research so that you're more knowledgeable and you're not caught by surprise or nothing is unexpected. And, you know, when things do come up unexpected, they can be costly. So it is important to at least become familiar with this process looks like. It's not as easy as going grocery shopping. It's not as easy as planning a, you know, summer trip or vacation. This is a home buying process, so it should take some time. And one of the things that I would just like to mention, you know, very brief, and I don't think we cover this, but let's just say you do end up purchasing a home and you have this interest rate, and let's just say rates do fall, right? And you're like, wow, like I should have waited, or I should have, you know, purchased at a later time. Once you purchase your home, you do have the option to refinance, meaning you can take advantage of the newer interest rate or lower interest rate. So that is an option in the future. So if you do decide to purchase a home, great, congratulations. And let's just say rates continue to fall down, you can refinance and take advantage of the lower rate.
Love that. Thank you. It's even with that long-term fixed rate mortgage, you don't necessarily have to stay at that rate for 30 years if you do choose to refinance. So always good to remember there's some flexibility. Well, thank you to both of you. Your expertise has been incredibly helpful to our military audience today, and GoVA is so honored to partner with Bank of Hope and other banks throughout the country to really share a direct access to financial experts and answer the questions from our military and veteran community. So thank you both for your time. We will be back in several months with another Bank of Hope presentation. So please stay tuned for updates on those topics and speakers. And we hope to see you all again soon.